On behalf of the entire Gryphon Financial Partners team, welcome to our first quarter call, Navigating Markets in an Era of Tariff and Policy Risk. My name is Randy Bellner. I'm a managing executive at Gryphon, and let me start first with a sincere thank you for all of our clients who have entrusted us and allow us to serve you and your families. And for those potential clients and others that are on the call with us today, we appreciate the opportunity to share some insight, and we look forward to any opportunity to learn more about you and your objectives. Our purpose at Gryphon is quite simple. It's to make people's lives better, and I can assure you that everyone on the team is committed to doing everything possible to deliver on that purpose. For our format today, I'm going to be facilitating a question and answer session with three of my teammates and colleagues who have deep subject matter expertise across markets, policy, and investment strategy. First is Michael Solik. Michael is an advisor and head of our investment solutions team at Gryphon. And I also have with me Bob Swansborough and Mark Fleming, senior investment directors at Gryphon Financial Partners. Together, we will share our thoughts on how we see things today while being very cognizant of the ever-changing landscape that we are in. We've done our best to integrate all the questions that you submitted prior to our call today. You will also have the opportunity today to submit questions during the session. And if for some reason we haven't answered or we did not get to any of your questions, we will ask your advisor to reach out to you after the call to address that question. And then lastly, again, the call is being recorded, and we will send a link out to you after the call so you can check it out again if need be. So with that, really excited to get started. And Michael, I'm going to start with you. Lots of moving parts, lots of things going on here lately. Maybe kind of frame for us, give us your perspective on the market. Where are we?
Thanks, Randy. Thanks for the introduction, and thank you again, everybody, for joining us today. So just to kick things off with a brief update on where markets are at, how markets have performed so far this year. We're 3 months into 2025. It certainly doesn't feel that way, but markets have experienced a shift away from the low volatility, technology-driven market that highlighted the previous 2 years. And U.S. equities in particular have faced pressure, falling 10% recently as major market participants have repositioned amid increasing uncertainty posed by tariff rhetoric and potential impact to economic growth. Meanwhile, international equities have delivered stronger results, supported by attractive valuations, improving sentiment, and increasingly expansionary fiscal policy. Despite the recent pullback and the negative headlines, the S&P 500 is down about 1.5% this year, and global equity markets have returned nearly 10% over the last 12 months, with strong results from both U.S. and non-U.S. markets. So our goal today is to bring additional context to the current environment and provide our current outlook in the current policy environment. So with that, I'll pass the mic back to Randy to jump into our discussion.
Thanks for the framing, Michael. So, hey, let's jump right in and let's jump in on tariffs. It seems to have been the word of every day for the last few weeks. So, Mark, I'm going to start with you. Are tariffs bad for the economy?
Well, first we'll just start with what a tariff is and kind of go through that. So a tariff really is just a tax on goods imported into the economy. And at its core, it's basically a consumption tax. So similar to sales tax or taxes based on how consumers spend. So we want to think of tariffs as a tax on the economy, depending on, which there's two different ways that they've been framed. It's been framed that they're a tax that's paid by other countries, or it's a tax that's paid by consumers in the U.S. The real answer is, like most things, is probably somewhere in between, but it should be viewed as a consumption tax. And like all taxes, they typically have a negative economic impact, the tax itself, but the overall policy can either have a positive or negative impact depending on what those tax dollars are used for. So, in a vacuum, yes, tariffs can be bad for the economy and can have a negative impact, but it really depends on the context that they're used and what's used on the other side. I'd say comparing tariffs to other forms of taxation, it reminds me somewhat of estate taxes, and financial planners always describe estate taxes as an optional tax that you can choose to pay it, or you can do lots of mitigating strategies. And each strategy has, a plus or a minus. Tariffs are similar in that there are lots of ways for consumers and businesses to take actions that reduce the impact of that tax, on their lives. So generally, good or bad, it really depends on what the money's used for and the totality of the policy.
Wow. Thanks, Mark. There was a question that came in reading it. It said, well, what if the goal is not to eliminate tariffs, but rather create an external revenue source and reduce trade deficits to zero?
So generally, and a lot of what we hear is that the new tariffs that are going in place April 2nd are meant to be reciprocal tariffs, with the idea that if the other country brings down their tariffs, then our tariffs against them will go down. So really, in that context, the goal is to reduce tariffs across the global economy, which would have a positive effect, most likely. If that's not necessarily the goal, it's that we want to start bringing in additional revenue, which we do have a large deficit. So they are looking for ways to bring in revenue. Then you can see more of a negative impact. The tax itself would be bigger and last longer. And I think some of it trying to eliminate trade deficits. Trade deficits aren't bad. So we're a big country. We consume a lot more than the rest of the world could. We have much higher incomes per person, and we can't produce everything that we consume. So, we would expect to have some level of trade deficits with other countries throughout the world. And that's really not all that bad because it all balances out through kind of capital flows and balance of payments.
So let me ask you to extend that question, that answer a little bit. You referenced balance of payments, so kind of connect the dots for us there a little bit.
Yep. So when we trade with a country and we run a deficit, then that other country is going to have a surplus of dollars. And those dollars, they really can't spend those inside their country. So they have to do something with those dollars. They can either convert them back to their own currency, or what most likely happens is that they have to spend it or invest it inside the United States. And that's why we see such strong investment in our businesses here. You see companies like Toyota and Hyundai opening factories here. That's why we are able to run large fiscal deficits, is because we have these natural buyers of our government debt, that they have those dollars, they have to do something with it. Buying treasuries or investing in the United States is one of the some things that they can do with those dollars.
Okay, thanks, Mark. I know we'll talk a little bit more about some of those things and things history from a contextual standpoint as we go on here. Bob, I want to bring you into the conversation a little bit, and from an investment perspective, what do you think the biggest risk to like these ongoing tariff negotiations are?
So, of course, the news flow on tariffs and everything very, very fluid in terms of what's going to happen. Of course, the market's very anxious for clarity in terms of April 2nd. But when you're talking about the negotiations themselves, probably the biggest risk in my mind would be not knowing how long these negotiations are going to last. Of course, the markets hate uncertainty, and the longer negotiations would drag, of course, that would inject a lot more volatility in terms of the market itself. And if we were to have, say, these negotiations would not come to compromise or agreement, and we get into a longer term trade war, then we're starting to talk about things like disrupted supply chains, of course, and then possible economic slowdown. So, again, in my mind, I think it would be the length of time that, we could come to an agreement or negotiation in terms of the tariffs themselves between countries.
Okay. Thanks, Bob. I'm also interested in your perspective. We hear as much as we hear the word tariff, we've heard the word inflation for a long period of time now. So, from your lens, are tariffs inflationary?
So, and that's interesting. I mean, of course, we hear a lot of this in the media that the tariffs are sort of synonymous with inflation, and that's really not true. And we'll talk about that a little bit, but tariffs are typically inflationary in the short term. So, typically we see a bump up in inflation once the tariffs are inactive. But when you look at the longer term, typically what happens is there's a dampening in aggregate demand, and inflation typically subsides, in that type of situation. If you look back, the last 500 years of tariff history, and this is not only the United States, but also other countries, you know, typically after that spike in inflation, we start to see inflation start to float lower and possibility of outright deflation the longer it goes. So probably the 1970s were the only exception to this, and we had some other things going on there, Arab oil embargo, those types of things. So the other thing that we have to keep in mind as well, there's some offsets there. So tariffs typically lead to a stronger domestic currency. For example, if we have a 10% tariff imposed on imports, but the dollar appreciates 10%, that's pretty much a wash for consumer. So again, there's a lot of moving parts there, but bottom line, tariffs typically don't promote a sustained rise in inflation. Longer term, tariffs typically lead to contraction in disposable incomes and total trade, which ultimately lead to disinflation.
Wow. So thanks, Bob. So Mark, I'm gonna stay on because we've heard so much about tariffs and inflation in the everyday media. I would certainly like you to lean in a little bit here on your perspective.
Yeah, so I mean, at its core, there's the old saying that inflation is always and everywhere a monetary phenomenon, and basically what that's referring to is typically you get an environment where you have too many dollars chasing too few goods, and that's where you typically see sustained periods of inflation. And generally, since the Federal Reserve controls the money supply, that's where the too many dollars can get created. So Fed policy is typically a bigger driver of the actual inflation environment than, say, a tariff or a tax. And we wouldn't expect a tax to be inflationary. I think prior to the 1960s, we actually sometimes used income taxes as a way to fight inflation. We would raise income taxes when we started to see higher inflation. We kind of abandoned that practice during the Kennedy administration, but it used to be adding taxes used to be considered a way to reduce inflation. So in this instance, a tariff, it increases the prices of the goods that the tariff's applied to, but then that money needs to come from somewhere. So either there needs to be less demand for the goods that didn't receive the tariff or less demand for the goods that are tariffed. But ultimately, you're going to see a reduction in overall demand in the economy from the tax or from the tariff that does lead to that more disinflationary or deflationary environment rather than inflation. So that's something that we don't think that's the base case, but something that we would be watching for.
So I'm gonna press on you a little bit. So Smoot-Hawley, tariffs back in was that not the cause of the Great Depression? Mark, is that where we're going?
I mean, that's what your elementary school textbook would say, and it would say that in the stock market. But typically, more, as people have worked on PhD level work on the Great Depression, it's really been shown that tariffs were not a major factor, and they really couldn't be. So if you look at the numbers, so back then, gross trade, so if we just add imports, exports as a percentage of GDP, was only about 11%. So we imported 5.5% of our economy and we exported 5.5% of our economy, roughly. And if you just think about it, we're talking about the 1930s. We didn't have big ships. We didn't have airplanes. We didn't have high-speed rail. Global trade just wasn't that big of a factor. So if we look, it was Ben Bernanke really kind of wrote the definitive work on, causes of the Great Depression. And really, I mean, his conclusion was more the fragility of the financial sector, which we saw through bank closures and the kind of chaos that caused. Imagine, on Monday, you go to get money from the bank and it's not there, and credit cards didn't exist. The panic that happened within the banking system. And then really a big factor is the adherence to the gold standard. So the money supply couldn't adjust to the changing economy. So, in his work, he lists, I think, 12 causes, potential causes. 1 and 2 are the very strong. The 2 points we just said, tariffs are listed way, way down the list.
That is the exact opposite. I remember reading, back in the day in the book. So thanks for the feedback there. So I'm going to ask you both a question around kind of bottom line before we pivot away from tariffs. But Bob, what do you think the estimated impact of tariffs are going to be on the economy?
So certainly, and I'm taking this more from a historical perspective, but we'll certainly see a rise in inflation in the short term. But again, I would suspect that to subside just based on what's happened historically. And the longer, again, situation in terms of negotiations and things would last, that could possibly cause a slowdown in the economy. Hopefully not a recession. Recession's not our base case, but certainly could cause a slowdown in the economy.
Yeah. Thanks, Bob. Mark, as we close out a little bit on tariffs, what's your kind of bottom line thought on impacts?
I mean, I think the bigger impact will be driven by the impact of the uncertainty related to tariffs rather than the tariffs themselves. So the actual dollar amounts, there might be, a small or medium-sized business that the tariff could essentially, put them out of business. But generally across the economy, that impact would be dampened. So that I think the actual tariff impact probably won't have a major impact on the economy. But the uncertainty about the business environment and how long this negotiation goes on is where the bigger impact can come in. I always like to say business leaders can work with bad policy. Even if a policy is bad, but you know what it is, a smart business owner or smart CEO can come up with a business strategy to work with it. If the rules of the road are unknown, then they can't come up with that strategy, and then it might cause them to pause or try to wait for some clarity, and that in itself causes a slowing in the economy. So just that pause, and so that's more of the concern. I do think somewhat it gets tough from a stock market perspective because the market somewhat drives the uncertainty. Executives and business owners tend to feel good when the market's going higher. They tend to feel bad when it's going lower. So in some ways, it's also dependent on not only the trade negotiation, but how the markets trade during it, because it has an impact on the thinking of those players.
Do you think, I mean, just an add-on here, do you think some of this is just reduced earnings visibility kind of in the short term here? Is that driving a lot of fluctuation?
I think so. And I mean, luckily we're coming in at a pretty high level. I think the estimates for the S&P are to grow earnings 11% this year. So we do have quite a bit of room before that gets to zero. Generally you're okay as long as there's a positive number in front of that growth rate. And we've had several kind of earnings recessions where earnings declined, but GDP didn't. And the market, we'd see a correction, but it's usually relatively short and shallow in that environment. But we do have that 11% cushion. So we've got a long way for earnings expectations to go. And very little of, say, the S&P 5 earnings is directly impacted by tariffs.
Okay, thanks, Mark. So I'm gonna keep you on hook for a minute, but I want to pivot away a little bit from the tariff talk and maybe get into some other policy related issues. And I want to start with regulatory things. So we've heard a lot about regulatory reform, and maybe Mark, give us a little perspective on that.
Yep. So yeah, if you're going to talk about the policies that can have a negative impact on the economy, you've got to talk about some of the policies that can have positive impacts. Looking at some of the estimates, we did see, and I'll take these with a grain of salt because they're estimates on the regulatory burdens that were put in place over the last few years. Those estimates are as high as 6.5%, which we are going to take those with a grain of salt, that they did come from. Typically, it's more conservative-leaning organizations that give those estimates, so it likely overestimated the impact of regulation. But we do think there is some room to help businesses and add some productivity to the economy as they work to deregulate. So, one big area that will help a lot is on the banking side. there's some changes on the regulatory front that will free up some capital that, banks are somewhat the lifeblood of the economy. If banks are lending, it's hard for the economy to do poorly. So those regulatory changes, should have a positive impact. And those are coming in globally. Those are Basel global regulations. So, that should help. Also, just looking at, reducing the impact on the burden of regulation, which just want to say, reducing the burden of regulation doesn't mean, allowing a business to go out and dump chemicals into the water. It often the cost of regulation isn't doing the right thing for stakeholders. It's proving to multiple sets of regulators that you did the right thing, going through and proving that you didn't put it in the water, and proving it to multiple groups that you didn't. So, one good example, I got an email from the SBA last week, the Small Business Administration. It was related to cutting regulatory costs in the manufacturing industry. So they said their goal was to reduce the regulatory burden by $100 billion across the manufacturing sector. And in that email, they gave an email and a phone number to call to report what are redundant and overly costly regulations. So if that's done right, we could see a reduce in that regulatory costs and an uplift in GDP and uplift in earnings. And if it's done right, we can still keep clean water and still do all the right things. So, but that's just one example they're using to, try to reduce that burden.
Okay, thanks, Mark. Bob, there's probably three legs to the policy stool. The second one being tax, tax reform. So maybe share with us some thoughts there.
Sure. So probably this is more of a second half of the year situation in terms of things. But if you recall, we have in place the Tax Cuts and Jobs Act. I believe that was enacted maybe in 2017, but that act sundowns this year. So, the administration, of course, is certainly going to work hard to extend that. There's also been some rhetoric around possibly decreasing the corporate tax rate from 21% to 15%. So the hope is that those tax cuts will stimulate demand, especially on the corporate side. Of course, lower taxes lead to increase in profit, and hopefully that will incentivize businesses to expand, hire more workers, increase capital investment, etc. But probably the key to that is, those savings have to be used or invested in productivity enhancing technologies, or of course, increasing capital stock. If those tax savings were invested in things, for example, like stock buybacks or increased dividends, we're not going to see injection in terms of growth in GDP in that type of situation, or at least not as large of one in terms of things. So, the other thing, of course, we have to keep in mind, and maybe you'd call this a con in terms of, the tax situation and enacting more permanently that the parts of that act. Those tax cuts, of course, we talked about boosting the economy, but we're also going to see higher budget deficits, higher borrowing costs possibly, and a higher national debt. So, that's sort of in focus as well. So, all these talks are going to be, again, second half of the year, probably not looking for any action till the beginning of next year in terms of those proposals.
So third leg of stool then, Bob, you start to connect, rates and policy on rates. Last week, Fed funds target was held firm. I think you started to see a shift in maybe some of the voting with members of that. I think 8 of the 19, forecasted maybe 0 or 1 rate reduction between now and the end of the year. So a couple comments, any comments on rates and trajectory there?
So if you recall, second half of last year, the Fed actually started to reduce rates, made a series of cuts. They were made in response to inflation being on the decline. The Fed, of course, has a 2% target in terms of the Fed funds rate. Currently inflation's running somewhere around 3%, and the rate of decline in inflation has slowed. So, pretty much the Fed has put the brakes on in terms of rate cuts, at least for now. And of course, there's a lot of uncertainty with what's going on, what we talked about earlier with tariffs and how that's going to affect inflation. But even with all that in mind, when you look at what's being projected this year, there's still being projected 2 to 3 quarter basis point, 25 basis point cuts by the Fed this year. So again, I think once we get some more clarity around the tariff situation and how that's affecting inflation, we could certainly, if inflation, stays status quo or even resumes decline, we could certainly see the Fed resuming its rate reduction situation that we had last year. So we certainly don't see the Fed increasing rates at any time soon. We certainly believe the next movement in rates by the Fed will be a reduction in the Fed funds rate.
Okay, thanks, Bob. So I'd really like to kind of shift the discussion a little bit. We've talked a lot about tariffs, what they are, what's going on, and as well as some policy things. Start to maybe talk more about implications to portfolios. So I'm really curious from both of you, and I'll start with you, Bob. From a strategy perspective, as you're sitting here today, are there things you've been discussing, you're implementing into portfolios that we can share?
Sure. So I guess first and foremost, keeping that long-term focus is very, very important. Even though the market is only down, like Michael had mentioned, somewhere around 1.5% for the year.
Mm-hmm.
And, we've seen a market correction, and that's, pretty much defined as a 10% reduction, in terms of market levels. When you look historically, those have been proven to be great buying opportunities. So, there's not only opportunity there, again, keeping that long-term focus, not only opportunity on the stock or equity side, but we also believe there's opportunity on the fixed income side as well. Staying diversified, very important. Diversified not only across regions, but sectors, industries, market cap, etc. Certainly, and this year so far has been a great example. I mean, we've seen international markets actually outperform the S&P 500 and domestic markets. So having that exposure on the international side has helped the returns this year so far, at least for the first quarter. And the other thing to make mention is rebalancing, of course, makes sense when you have exposure, you're overexposed to certain areas of the markets, or if you have a misalignment. Those are probably the things that we're talking about the most, at least for now.
Thanks, Bob. And Mark, from your vantage point, strategically?
So, I mean, generally, we shouldn't be changing, really what we're doing based off of, current market movements or, news headlines. Really, we want to make sure that every client is in kind of the right long-term objective for them. But when you do see bouts of volatility, it does bring some opportunity. So, of course, clients that had cash, we were wanting to put that to work as stocks were lower. So it always gives an opportunity to invest up to what was your particular set objective. If you get larger moves, this move hasn't been big enough to where your stock bond allocations really got out of whack. But if you want to say own a 60-40 portfolio, 60% stocks, 40% bonds, and if stocks have a large decline, your stocks are no longer 60% of your portfolio. They can become 55, 50 and then you use that as an opportunity to bring it back up to 60, which then means you participate more on the way up. So we want to keep our objectives the same, but as a investment advisor, we might do some moves within your objective, mostly to keep you in line with your objective. In our individual stock portfolios, we've done a few individual security trades, but nothing, no wholesale changes in the portfolio. We do think, since our view is that inflation is not, that tariffs are not necessarily inflationary, that it is an opportunity to move cash into bonds or longer term yield vehicles. Because over the long term, the yield of cash should be, about equal to inflation. We have above inflation yields on cash instruments today. But that's not the long term. That's not what is typically normal for the long term, and probably not what we should expect for the future. So if we have, money that it needs to be invested conservatively, it's probably a good opportunity to invest it in something longer term.
Okay. I want to, thanks. I want to come back to something Bob started to reference, Mark, specifically on the international markets. I mean, the year started off obviously very, very strong. Kind of what's been behind that, and do you think? I mean, nobody has a crystal ball. Do we think that can continue and outpace performance of the U.S.?
I mean, I think it can. And kind of coming into this most recent environment, kind of looking at international markets, it did look like they had a chance to potentially outperform. And a good phrase I heard the other day, I wish I had came up with this one, is the reindustrialization of Europe. And I think that's part of the current administration's policies will encourage more industrialization within the EU economy. And we're also seeing a very stimulative move from the Chinese economy. And that I think there is some bifurcation between kind of global trade, where both the Europeans and the Chinese are going to look to stimulate within their internal economies. And, coming from such a low rate, so Europe and China were both trading at very low valuations. There's more room to recover there than necessarily we have in the United States. So I think there's a good opportunity in international markets. I'll put the caveat that every 3 to 4 years, it seems like there's a good opportunity in international markets, and it never works. So, somewhat we're, Charlie Brown in the football on this. And I think everyone in the market is. The same thing happens with small caps. This one feels better to me than in the past, where it's looked like there's opportunities in international markets, but it's far from a sure bet or a known thing.
Hey, thanks, Mark. Hey, Bob, I want to bring you back in. We haven't talked a lot about, but you started to touch on fixed income, and some perspective there. So maybe even connecting the policy risk to the fixed income, kind of where you started. So can you give us a little more insights there?
Sure. So when we were talking about the Fed a little bit in terms of, direction, at least where short-term rates are going, like I had mentioned, I mean, there's probably more of a probability that the next move in terms of interest rates is going to be down versus up. So keeping that in focus, and I think Mark touched on this a little bit, there's certainly opportunity in the fixed income markets when you consider that rates could be going lower. So at this point, taking a hard look in terms of portfolios, if we do have cash to be able to invest on the fixed income side, actually looking at locking in some of that yield, at least where things are now, because projecting out in the future, of course, yields could be lower. So which would be again, it is a good situation for investing in bonds, at least at this point. So I know I've been doing a lot of that within portfolios. I'm sure Mark has as well. But again, we do see opportunity in fixed income for sure.
Okay. Can I come back to you on one last thing on equities?
Sure.
So lots of conversation out there about elevated price to earnings ratios. Maybe provide some context on that, what it means. I think it's more the forward-looking PE that there's some angst about. So can you shed some light for us?
Right. So if you look at the S&P 500 in terms of its forward price to earnings ratio at this point, we're trading at about 21 times, which when you look at that versus historical basis, it's certainly elevated. But one thing that I try to tell clients is the PE ratio, even though it looks elevated, it doesn't give us a lot of insight into whether stocks will do well in the short to intermediate term. Like Mark had mentioned earlier, we're looking for, or at least analysts are looking for, somewhere around 11% profit growth this year. So, we had, in terms of valuations, we had a lot of expansion in terms of the multiple over the past 2 years. So, what we're looking to see is to be able to grow into that multiple in terms of earnings. So, again, PE ratio, it's something on the radar for sure. But again, when you look into short to intermediate term, certainly doesn't, not a good guide to look at in terms of how markets will perform in the short to intermediate term.
Thanks, Bob. Hey, Mark, we received a couple questions around stagflation. So we talked about inflation and we got questions around stagflation. Can you maybe, for the benefit of all of us, talk a little bit about quickly what it is, maybe, what we think the potential, or we're hearing the potential of it is, and then if we think there's some potential, could you maybe give a little insight as to how it might impact M&A markets?
Yep. So, I mean, we think obviously the odds are not zero. But we think the odds are very low that we really see a major sustained stagflationary environment, which stagflation is typically defined as high unemployment and high inflation at the same time, which can be particularly troublesome is because they're viewed as opposites. That usually you have inflation when you have a strong economy, you have high inflation, and when you have a weak economy, you have low inflation. So in somewhat, it's kind of a, I guess, oxymoron that you could have stagflation in the economy. And there's still a lot of memory of that 1970s stagflationary environment and just how tough that was. We do think looking back at that era, similar to the Great Depression, there's a long list of what people viewed as causes of that inflationary environment. I mean, I think, again, the two drivers seem to be, one, we moved away during the Kennedy administration in the 60s from using taxes as a way to reduce inflation. We kind of held a stimulative tax policy when, how they had reacted before, they would have been more restrictive on the tax side. Surprise, surprise, Congress lost the appetite to raise taxes. And then also there was a big impact that, there was some pressure on then Fed Chair Arthur Burns to keep interest rates low, even though inflation was starting to pick up, and that gave inflation a chance to take hold. We don't use tax policy to, try to control inflation anymore, but the Fed is still pretty active. We are seeing some repeats of, I think that's why it comes up a lot, is that Arthur Burns kept rates low because he received pressure from Richard Nixon. Obviously, there's some pressure to keep interest rates low. But it's hard to see really the Fed taking the bait on this. It's that, I feel like it's that old analogy that it's the punch you don't see coming. If among Fed circles, the most likely thing that could cause that is the Fed, maintaining a stimulative environment because of political pressure. It makes it less likely to happen again. So, the odds of exactly repeating that 1970s cycle, even though they rhyme a lot, I feel is relatively low. And kind of like we said, if tariffs are more of a tax on the economy, taxes are more disinflationary or deflationary than inflationary. As Bob mentioned, you could see a spike up in a price of a basket of goods for a month or two in the CPI report, but something is going to give on the other side, because essentially businesses and consumers can only use their credit cards and their savings for so long to absorb those higher prices. It has to flow through. So, we do see that as a very low odds scenario. It is always mentioned because inflation's always high whenever you go into a downturn in an economic cycle. And that's because cycles usually ends because the Fed's raising rates. And as Bob mentioned, it's the Fed's much more on an easing cycle than a raising cycle if we're looking for like an end of this particular cycle and heading into recession. So, impacts on M&A, obviously stagflation's not good for M&A because you'll typically see inflation, interest rates go up with the higher inflation, which then means, there's usually some aspect of debt in most acquisitions. So if you increase the cost of capital, the valuations of the businesses are going to need to come down. And I think a lot of the times you just see business owners decide not to do the activity. So, if we had a stagflationary environment, that would be, very negative for M&A. We'd see, a major pause in M&A really across the board. You'd probably see some, aspects of, in the big corporate world and, large cap M&A, stronger players taking out weaker players that couldn't manage through the inflation. Because I think inflationary environments really kind of separate strong management teams from weak. Really good management teams can manage their costs, raise their prices to manage, work through that environment. Weak management teams can't. They don't manage their costs. They don't manage their revenue. So then that sets them up to be taken out. So you could see some more distressed, but overall activity would be lower in that environment. Even without stagflation, I would think the M&A environment should start to pick up. I think last year was a down year for M&A. I think generally policies are supportive of M&A. We're seeing interest rates come down. There's still some aversion to very mega cap M&A. We're not going to see Bank of America and JP Morgan merge, but you might see First Bank of Tacoma and Second Bank of Tacoma merge, and we'll probably see a lot more of that type of activity.
Great. So I said I didn't think I'd do this, but there was a question that came up back on tariffs, and Mark, I'm going to keep you on the line here. How do you feel they're impacting just sentiment, both in the public and the private markets?
So, they definitely are, and some of that is, especially when tariffs send stocks lower. Because there's always a correlation between, what drives what, sentiment or stock prices. You never know. And I think when people do see stocks going down, there tends to be, it's almost justifies what they're worried about, so they become even more worried about it. So, it's definitely is a negative impact. There are indexes on kind of policy uncertainty. And, we're really at about as high as that policy uncertainty gets. And, on the actual index itself, which, if anybody watches the news, I feel like we have less clarity than we've had in the past. I'll say the good news is that you want to buy when there's blood in the street. Usually it's a better time to invest when those types of fear indicators are at their peaks. Because I've always had this old saying that, the money in the market's made when things get less bad. So if you're in a, kind of a bad, difficult environment, you see the biggest upward movement in asset prices when things just get a little less bad. And so it sets you up for that less bad environment. So if we're at peak uncertainty, we'll start to see at least some of that uncertainty start to wane. And that's typically really good for asset prices. Just code for stocks.
Yes, for stocks. That's it. Hey, Mike, I want to bring back in. You kind of kicked us off a little bit today with kind of where we are, and we've heard, lots of things. And I guess, I'm always sitting there saying, so what do you do with all this and things? So I got two questions for you. I'm going to start with one that's, there's a lot of uncertainty, generally swirling around the current administration's policies that seems to have driven a lot of the recent pullback that we've had. Over the long run, how much do you think this really influences markets?
Great question, Randy. So I'm actually just going to pull up a chart here, and hopefully everyone can see it. But what I would kind of lead off with, and this will be a good way to start to wrap up the conversation, is there's always uncertainty. There's always a reason to be worried about the market, worried about the economy, and there's always going to be risks out there. So this chart we've shared with you all before. This chart just overlays the S&P 500, which is the white line on the chart here over the past 14 years. And then behind it, the shaded bars highlight what various asset managers around the world were worried about at any given point in time. So the point is, and the takeaway is, there's always been something, and there will always be something or some group of concerns and factors that asset managers and investors are worried about. And the takeaway is when we build our portfolios, we're building them for the long term, right? There will be volatility in the near term. We're going to manage through that. We manage our portfolios with that strategic mindset. And it's all about being in the market for a long period of time, not timing the market, but time in the market.
Fantastic. So I think that's kind of the wrap, right? So any other guidance you would share, kind of where we go from here?
Yeah, so if there's really two key takeaways we would emphasize today, and this will be no surprise to anybody on the call, but one, there will be uncertainty, and with that uncertainty, we would emphasize that diversification works, especially during volatile markets such as this one. So when we build your portfolios, we build them intentionally to maintain different exposure to different asset classes and different regions, because they're all going to be influenced by different factors throughout a business cycle. And so by diversifying our exposure, we can greater protect your wealth. We can smooth out that volatility to the best we can. And that's been shown this year as non-US markets have helped offset weakness inside of the United States. The second takeaway we would emphasize is we build those portfolios with that long-term strategic mindset. So in the near term, there's no doubt volatility is unnerving. You pop open CNBC, the headlines are talking all about it, but it's a normal part of the stock market. So this recent 10% pullback, it happens about two or three of every 4 years. And on average, in any given year, the S&P 500 pulls back about 14 or 15%. So it's common and it's expected, and it just feels unnerving because we haven't had a whole lot of it since 2022. And so there will be risk, there will be uncertainty. Protecting our clients' wealth is our #1 priority. And we do that by ensuring there's enough liquidity to support known near-term needs. And I know we talk about that all of the time. And then with the rest of the allocation, we build those strategic allocations to support your long-term growth and your long-term goals and objectives.
I think you're spot on, Michael. It never feels good, I think, is the takeaway. And it's funny, we were working on this just a couple weeks ago. I think the market was off 8, 9, 10%, and and here we are. We've almost kind of recovered all of that. So, hey, I want to thank panel members here for the conversation today. More importantly, I want to thank everybody for dialing in and investing your time with us. We really do encourage you to provide us feedback. We want to hear from you. We hope you found the discussion beneficial. At the end of the day, everybody, we're here to serve you. It goes back to making people's lives better. That's our sole goal. We're honored to have the honor to do that, to serve you. And I would ask you to watch for an invitation for our next quarterly call that we look to host towards the end of June. And in the meantime, feel free to reach out to anybody in your team, and we'll be in contact with things. And Bob, Michael, and Mark, unless you have anything else you want to add, we can get these folks off and on their day. All right. Thanks everybody for dialing in.
Have a great day.
Bye.